This didn't happen slowly. It happened in the first 4 trading days of December 2025, approximating a 72-hour window, and almost no one noticed. A single exchange, COMEX, saw over 60% of its registered silver claim for physical delivery, pulling millions of ounces out of vaults that were already strained. Officially, we're told the silver market absorbed the pressure without issue. The price stabilized around $65 per ounce after a brief spike. The exchanges reported normal operations, and analysts described it as a routine adjustment in a volatile year. The market is functioning, and nothing is wrong, but there's a detail that doesn't fit, and it's been quietly removed from the conversation. On December 4th, 2025, video reports and market analyses highlighted this COMEX shockwave, where delivery demands erased more than half the available inventory in days. The London Bullion Market Association, LBMA, a key player in global silver flows, had been reporting critically low inventories since October, yet this surge wasn't flagged in mainstream updates. Instead, focus shifted to year-end economic outlooks, omitting the role of major banks like JP Morgan, who faced delivery delays extending to 60 days. The physical silver market had been showing fractures for months. Dealers across the US and Europe began freezing sales, not due to policy, but sheer unavailability. One report from Phoenix Refining in October noted major refineries refusing more silver scrap, citing overwhelmed capacity. In India, Kotak Mahindra and other funds halted new investments in silver ETFs, blaming a domestic shortage that drove local premiums sharply above benchmarks. These weren't isolated incidents. They formed a pattern of supply constriction that the COMEX event amplified. Silver's role extends beyond investment. It underpins critical technologies, yet the narrative around its availability remained sanitized. Prices on screens suggested abundance, but vaults told a different story. By mid-December, projections indicated China's silver vaults could be functionally empty, exacerbating global tightness. This wasn't a gradual erosion, it was a rapid drawdown, hidden in plain sight amid holiday market distractions. The freeze wasn't announced as such. It manifested in halted transactions, delayed shipments, and premiums that made physical acquisition prohibitive for average buyers. In Shanghai, silver closed at $72.65 per ounce on December 23rd, with premiums widening to over $3 above global spot, signaling a worsening shortage. Bullion banks attempted their usual interventions, dumping futures contracts to suppress prices, but Shanghai AS market simply dragged prices northward upon opening, rendering those efforts ineffective. This disconnect grew from years of structural deficits. The Silver Institute reported a 149 million ounce shortfall for 2025, driven by industrial offtake that showed no signs of easing. Yet, the official line held, markets are resilient and supply chains will adapt. Omitted was the reality that physical silver isn't infinite. Once claimed, it doesn't recirculate easily. The COMEX event marked the point where paper promises collided with tangible limits. Observers noted similar strains in prior months. In October, LBMA vulnerabilities were exposed as inventories dwindled and lease rates hit records. Physical shortage stress hit global markets by year's end, with UK silver imports reaching a record 2,077 tons in October alone, much from the US and Switzerland, only to export portions to India. No flows to or from China were recorded, hinting at a deliberate rerouting to plug gaps elsewhere. The unsettling aspect lies in the silence. No emergency press releases from exchanges, no interventions from central banks to stabilize, just a quiet acceleration of claims that depleted what little was left. This wasn't panic selling, it was strategic withdrawal by those with access, leaving retail investors to navigate inflated premiums. In the US, trying to buy 100 ounces revealed the fiction. Spot prices meant little when delivery lagged weeks, if at all. As the freeze unfolded, it exposed the fragility of a system reliant on fractional reserves. The LBMA, highly leveraged, had borrowed physical silver from China earlier in the year, only to return it amid widening backwardation, where physical commanded premiums over futures. This wasn't a market correction. It was the beginning of a separation between what exists on paper and what can be held. The narrative omitted these mechanics, focusing instead on silver's 120% gain for the year, framing it as a speculative bubble. But the data suggested otherwise. Refineries stopping intake, dealers freezing sales, and exchanges hemorrhaging inventory. This 72-hour window wasn't an anomaly. It was the signal that physical supply had crossed into irreversible territory. And behind the scenes, the LBMA did something very specific. Not announced, not explained, but irreversible. They leased physical silver from Chinese vaults to shore up their own depleted stocks, rerouting shipments directly to India via dropshipping to avoid detection, only to face repayment demands as China's premiums surged. This action locked in a cycle of dependency. The consequence? Global physical flows stalled, with UK exports to India hitting 493 tons in October, while imports ballooned to plug the gaps. No transparency followed. Instead, silence from the association. as lease rates soared to records, exposing vulnerabilities that had been building since early 2025. On screens, silver is $65. In the real world, it's $72, if you can even find it. Delivery delays stretched to 60 days at major banks, premiums spiked to 20% in some markets like India, and inventory disappeared from key hubs. Trading halts weren't formal but effective. Indian silver ETFs suspended new units, citing unavailability of physical bars. In the US, 1,000-ounce bars entered verifiable shortage, with London struggling to source them. These weren't abstract figures. Reports from October detailed how top refineries refused more scrap, overwhelmed by demand that outstripped processing. Phoenix Refining highlighted alternatives for scrap holders, but the core issue remained: supply chains buckling under persistent deficits. By December, videos circulated of dealers outright freezing sales, declaring physical silver gone. The insider moves extended to major players. JP Morgan, long a dominant force in silver futures, faced scrutiny over delayed deliveries to India, extending terms to T+60 amid the squeeze. This wasn't voluntary. It stemmed from the same LBMA borrowing scheme where leased metal had to be returned, tightening availability elsewhere. Chinese traders capitalized on arbitrage, buying foreign physical at lower spots and shipping it home where premiums exceeded $3 per ounce. Backwardation widened, a clear sign of physical stress. Shorts opened during this period hung precarious, as borrowing fees for vehicles like SLV cooled only temporarily. The danger lay in settlement. Paper positions required delivery of metal that simply wasn't there. In Shanghai, prices traded at 3.4% above LBMA fixes, incentivizing further imports but straining global stocks. Institutions like Tata Mutual Fund joined the freeze, suspending fresh investments due to the same domestic shortages. This cascade affected retail access, where buying physical meant paying 7 to 8% premiums in some regions, far below ETF markups, but still indicative of broken pricing. The market's fiction became evident. Spot quotes bore no relation to acquisition costs. Leaks from insiders painted a grim picture. One analyst noted, "The LBMA is cooked," referring to their inability to source 1,000-ounce bars. Another highlighted Indian ETF inventories surging 20 million ounces in September alone, nearly 50 million for the year, yet still insufficient. These moves shifted authority from media narratives to those handling the metal, revealing a system where paper suppressed reality for too long. The unsettling truth: these actions weren't reactive but preemptive, by entities aware of the deficits. The Silver Institute's data showed industrial demand holding strong despite economic uncertainty, with offtake from technology sectors accelerating, yet no public acknowledgement followed. Instead, the freeze deepened, with physical silver becoming a privilege for those with direct access to vaults. This would be manageable if demand were falling, but it isn't. Electric vehicles and their infrastructure consume vast quantities, with the Silver Institute projecting average annual growth in automotive silver use through 2031. Solar manufacturing hit record highs, electronics surged with AI data centers, and military applications expanded amid global tensions. Grid upgrades and AI hardware don't pause. They accelerate, pulling silver into systems that don't wait for price discovery. These drivers compounded the 149 million-ounce structural deficit for 2025. Industrial demand rose despite higher prices, forecasted to expand across key sectors like EVs and solar. The U.S. even proposed classifying silver as a critical mineral in its 2025 draft list, reframing it from monetary asset to strategic resource. Investment demand added fuel, pushing prices above $67 in surges, yet physical tightness persisted. This is where banks usually intervene. They cap the move. They calm the market. This time, they didn't. Position changes went unannounced, with major bullion banks like JP Morgan maintaining silence amid delivery extensions. Rule adjustments at exchanges aimed to ease pressure, but compliance came suddenly and without fanfare, allowing the freeze to embed. The reaction, or lack thereof, signaled a shift. Central banks, focused on gold reserves, offered no similar support for silver. The Federal Reserve's rate cuts and end to quantitative tightening indirectly boosted precious metals, but silver's industrial pull made it unique. Tariff fears dislocated physical markets further, with no interventions to bridge the gap. Demand collision manifested in metrics. Solar energy alone drove highs in 2024 offtake, carrying into 2025 with EVs and AI. The Silver Institute expected global demand at 1.12 billion ounces, down slightly but still in deficit. Automotive silver use surged, infrastructure for charging networks added layers, and AI's 5.252% projected IT power increase translated to more hardware reliant on silver conductivity. Banks' non-intervention left premiums unchecked. In China, silver traded at $67.43 with 3.4% premiums over LBMA, drawing in arbitrage but depleting Western stocks. Indian flows absorbed U.S. exports, yet shortages forced ETF halts. Military and grid needs, less visible, locked away ounces in non-recyclable applications. The system's lie became apparent. Screens showed $65, but acquisition meant $72 or more with delays. This wasn't resolvable quietly. Demand's inexorable rise clashed with exhausted mines and refineries. Projections for 2026 suggested silver could outgain gold again, but early headwinds from unresolved 2025 deficits loomed. Once the COMEX registered inventory threshold broke, dropping 60% in days, the system can't go back, not because of price, but because of trust. Supply exhaustion set in, with delivery failures rippling through chains and political interference emerging as governments prioritized strategic stockpiles. China's vaults neared empty by mid-December, triggering shortages that widened global cracks. Physical stress hit markets, with refineries halting intake and dealers freezing sales. Trust eroded as paper promises failed to deliver, echoing fractional reserve vulnerabilities at the LBMA. We've seen this before, not in silver, but in the 1971 gold window closure. President Nixon unilaterally ended dollar convertibility to gold, freezing redemptions amid depleting reserves and foreign demands. It wasn't gradual. It was a shock that ended the Bretton Woods system, shifting global finance to fiat. Similarly, today's silver freeze marks a disconnect where physical scarcity overrides paper controls, just as gold's 1971 event did. Parallels extend to 1980's silver spike, driven by Hunt Brothers squeeze, or 2008's liquidity freeze where trust in banks vanished overnight. In 2020's repo panic, markets seized amid hidden shortages. Here, silver's industrial bind amplifies the effect. Historical events like the 1973 oil crisis leading to fuel rationing show how supply breaks force regime changes. The threshold crossed in December 2025 wasn't recoverable. Inventory disappearance became permanent, with political moves like U.S. critical mineral classification signaling hoarding. Delivery failures in India and delays at JP Morgan eroded confidence, turning silver from tradable asset to guarded resource. Trust's loss is the core. Once actors question convertibility, from futures to physical, the system fragments. This wasn't about volatility, it was exhaustion, where deficits of 149 million ounces couldn't be papered over. The question isn't whether the silver price will move higher. The question is who still has access when it does. Markets do not announce resets. They signal them, quietly, in the background. Through mechanics, most people never watch. This was one of those signals. By late December 2025, the physical silver market had already separated into two distinct realities. One reality existed on trading screens. Silver quoted at $65, $67 per ounce. Futures contracts rolling smoothly, ETFs reporting steady inflows, and analysts issuing year-end forecasts that treated the metal as just another cyclical commodity. The other reality existed in warehouses, refineries, dealer counters, and private vaults. Delivery delays stretching to 60 days and beyond, premiums reaching 8 to 12% in Western markets and over 20% in India. Major U.S. dealers quietly freezing new sales of 1,000-ounce bars, and at least two prominent refineries in North America and Europe announcing they would no longer accept silver scrap for processing until further notice. These were not random disruptions. They were the visible edges of a structural fracture that had been widening for years. The COMEX registered inventory drawdown in the first days of December. More than 60% of available metal claimed in roughly 72 hours, served only as the public manifestation of a process that had already been running in private for months. By the time the headlines caught up, the metal had already moved, not to speculative holders, not to short-term traders, but to end users, strategic stockpiles and institutions that do not announce their intentions. The pattern is now familiar to anyone who has tracked the physical market closely over the last 18 months. October 2024. LBMA inventories fall to multi-decade lows. Lease rates spike to records. November 2024. First reports of major bullion banks extending delivery terms to India to T+160. Early 2025. Chinese arbitrage begins in earnest. Shanghai premiums consistently exceed $250 to $350 per ounce. Mid-2025. Indian silver ETFs suspend new unit creation multiple times due to lack of physical bars. September-October 2025. UK silver imports reach all-time highs, almost entirely rerouted to India. No documented flows to or from China. November 2025. Top-tier refineries in North America and Europe halt intake of silver scrap, citing overwhelmed capacity. December 2025. COMEX delivery surge. Dealer sales freeze across multiple independent networks in the United States. In Europe, physical silver becomes effectively unobtainable at quoted spot prices for retail and mid-tier buyers. Each step appeared isolated when it happened. Taken together, they form a coherent sequence, a slow bleed of physical metal out of the fractional reserve system, followed by a rapid acceleration once trust and convertibility began to crack. The most unsettling aspect is not the price level that may eventually print on screens. It is the asymmetry of access that has already been established. Industrial consumers, solar manufacturers, EV battery producers, semiconductor fabs, 5G infrastructure builders, defense contractors do not purchase silver on retail dealer websites. They contract directly with refiners, miners, and large bullion banks years in advance. Their offtake is locked in through long-term agreements that are rarely disclosed until after delivery has occurred. Military and aerospace applications often fall under national security classifications. The volumes involved are not visible in public data until years later, if ever. Central banks and sovereign wealth funds, while more focused on gold, have quietly increased silver holdings in certain jurisdictions where silver is treated as a strategic industrial input rather than purely a monetary metal. Retail investors, small to mid-sized fabricators, coin and bar dealers, and even some hedge funds that rely on paper proxies or allocated storage programs are now on the opposite side of that divide. They face premiums that make spot prices irrelevant, deliver queues that stretch into months, and, in some cases, outright refusals to sell at any price. The market has not closed. It has bifurcated. This bifurcation is not new in history. It is the way precious metals markets behave when physical supply reaches terminal constraint, while paper claims remain theoretically unlimited. In 1971, foreign central banks could still redeem dollars for gold at the official rate, until the moment they could not. The window closed overnight. Those who had already moved metal into their own vaults retained access. Those who waited for the official price to reflect reality found the door already locked. In the late 1970s, during the Hunt brothers squeeze, paper silver prices spiked to nearly $50 before collapsing. But those who held allocated, fully paid, physical metal in their own possession were never forced to sell into the crash. Access, not price, determined outcome. Today's signal is quieter, slower, and, for now, less visible to the general public. No single authority has declared convertibility suspended. No headline has announced that physical silver is no longer available. Instead, the market is communicating through friction. Longer settlement times, higher premiums, frozen sales, halted ETF creations, refineries turning away scrap, and vaults that no longer replenish. These frictions are the early language of scarcity. They are not designed to be understood by everyone. They are designed to be understood by those who already understand. The Silver Institute's 2025 to 2030 projections remain public. Persistent structural deficits, averaging 140 or 180 million ounces annually, accelerating industrial demand from electrification, AI infrastructure, and renewable energy, and very limited new mine supply growth. Yet the same report still frames silver as a market that will eventually balance. The language is careful. It does not say when. It does not say how. It does not address the question of who gets served first when the system can no longer pretend that supply is elastic. That question, of access during the reset, is the only one that now matters. The institutions and end users that secured physical metal in 2023, 2024, and the first half of 2025 are positioned differently than those who waited for confirmation. The refineries that stopped taking scrap did not do so because they stopped because incoming volume overwhelmed their ability to process and return refined bars into a market that was already claiming more than they could produce. Dealers who froze sales did not do so because they wanted to ration supply. They froze because they could no longer source bars at a price that allowed them to remain solvent if they honored existing orders. These are not acts of panic. They are acts of preservation. The quiet warning is not that silver will disappear tomorrow. It is that the window of broad access has already narrowed, and the mechanisms that once allowed ordinary participants to participate on equal terms are no longer functioning as designed. Paper markets can continue to quote prices indefinitely. Physical metal cannot be created to match those quotes. When the next leg of recognition arrives, whether triggered by another COMEX-style drawdown, a major industrial default on delivery, a sovereign declaration of strategic reserve status, or simply the exhaustion of remaining Western inventories, the asymmetry will become visible to far more people. At that point, price will likely follow. But price will be secondary. Access will already have been decided. Markets do not announce resets. They signal them, quietly, persistently, through the accumulation of small, boring technical failures that only become dramatic in hindsight. This was one of those signals. If you are watching this, you are early.